Parallel to the improvements that we witness in the design of exchanges and the way that traders are conducting their affairs using derivatives, we also see substantial improvements in the mathematics which underlay the estimation of the risks involved with future prices. There were substantial improvements in statistical and mathematical sciences in the 16th and 17th centuries with the works of Pascal, Huygens, Bernoulli, and Demoivre, and several others that ultimately made it much, much easier for us to try to formalize some of the relationships that we used for pricing out the different kinds of risk exposures that people who were buying and selling derivatives faced. In particular, one interesting breakthrough that underlays the pricing of modern derivatives came in 1863, where Jules Renault extended the notion of random and normally distributed outcomes to market prices and actually found relatively strong evidence supporting his theory. 3 decades later, in 1900, French mathematician Louis Berthollet published La théorie de la spéculation, which laid the groundwork for modern derivative pricing by effectively adopting Thorvald Thiel's earlier work on Brownian motion to option pricing. It's worth noting that mathematicians at the time gave Berthollet's work, for the most part, sort of a lukewarm treatment, simply because it was an area to which mathematics hadn't been rigorously applied before and was often seen as being relatively base compared to the realm of pure mathematics that his peers at the Sorbonne were writing about. As a result, it tended to languish for as much as 60, 70 years before economists and professors Black, Scholes, and Merton would effectively reinvent Berthollet's wheel and earn a Nobel Prize in economics for it. You might know this as the Black, Scholes, Merton option pricing model, in which a stochastic process is used to proxy for the evolution of future prices. Effectively, the model assumes that prices will proceed in a somewhat random fashion, just as Berthollet, and in fact, Renault had suggested they did as far back as 1863. Now, in particular, the implications of this model are very, very significant and led to a vast expansion of the kinds of markets for these sorts of derivatives. The expansion of these markets was so large, in fact, that today there are literally trillions of dollars worth of market price in derivatives being exchanged on a regular basis. In large part, the expansion of derivative usage came with the formalization of option pricing models and improved mathematical tools for estimating the quantities of risk that sellers were actually exposed to. But it's important when we're trying to understand the size of the derivatives market that we distinguish between 2 separate measures. One, the notional exposure of derivatives, and 2, their market price. The notional exposure generally refers to the reference amounts that are referenced in the contracts that the value of is ultimately derivative upon. So for instance, let's say we had a contract for a single payment that would be based off of a 0.5% or 0.5% interest rate spread based off of a notional exposure of $100. That being a single cash flow would only have a price of 0.5% of the notional exposure, meaning that this type of derivative contract would only have a market price of roughly 50 cents, possibly with a slight premium over it to account for future volatility between now and expiration. But the notional value of that derivative exposure, the reference sum upon which the value is calculated as 0.5% of what, is much larger at $100. So with this in mind, when we try to understand the scale of the derivatives market, we have to remember that there's always going to be 2 numbers reported: the size of notional exposures and the actual market prices that give us a better idea of the actual risks involved. So at the end of 2019, the Bank for International Settlements, which helps to acquire some of the, or centralize some of this data, estimated that OTC derivatives had a roughly $560 trillion worth of notional exposure, which is approximately twice the total value of goods on Earth, which gives you some sense that we're talking really about a reference number that we're going to multiply by usually fractions of percents in order to determine what cash flows actually are. And it's worth noting that this $560 trillion worth of notional exposure actually only trades only for a total of $12 trillion, the majority of this being interest rate swaps. Now, when we take a look at open exchanges, open interest rather in exchange traded futures and options, about 85% of which is in North America, we see a similar sort of pattern with the notional exposures tending to overstate the actual risk exposures that are better approximated using market prices. Now, what kinds of risks can be covered in this modern world of sophisticated quantitative finance? Well, it turns out just about anything. Even though derivative contracts were historically based off of things like commodity prices like corn or oil, we now see that a wide array of financial risks can be covered. You can buy futures contracts or options, for instance, on stock indices, bond yields, estimates of consumer price index, interest rates, foreign exchange rates, etc. In fact, since futures exchanges are ultimately competing to attract new trading, remember, they act as a market maker and do capture a bid-ask spread every time someone trades, they're regularly introducing new products. Some interesting sort of exotic examples that are usually fly under people's radar include, for example, futures contracts based on temperature or rainfall or date of first frost, all of which can be relatively important to farmers who might be negatively impacted by, say, droughts or early frost or heat waves. We also have futures that are that generate payoffs based on whether or not there are electrical disruptions. The original market for this was in California in the early 2000s when the deregulated market for electricity led to rolling blackouts, but have since become relatively popular in India, particularly with electrically intensive industries like shipbreaking. Similarly, there are futures to help that pay out when there are oceanic or delays in oceanic freight. If, for example, a large storm in the Pacific causes a delay of 2 or 3 days on a large shipping vessel Walmart is using to bring in new goods, there may be a derivative contract that pays out to accommodate for this kind of risk. Similarly, there are derivative contracts, catastrophe bonds in some cases, that are paying out when natural disasters strike, like large-scale floods or tornadoes or hurricanes. Interestingly enough, some people have actually proposed trying to sell futures contracts, or rather buy futures contracts, based on the price of retail housing. And this has been floated around for several years now. But despite there being a lot of demand of people hoping to lock in their high prices for the future, what we've consistently seen across a number of countries is that there's no one willing to sell those kinds of guarantees. Ultimately, there are a lot of non-standardized risks that can't really be controlled for when it comes to housing. There may be limited enforcement that ultimately relies on eviction, and most market makers in this space have ultimately determined that it is simply too risky for their blood. Nonetheless, we expect to continually see new innovations taking place in this space as people try to find other risks that can be quantified that people are trying to control for.